What if I told you there's a way to profit from real estate without ever owning a single property? Well, today we're diving into the world of mortgage note investing. It's a place where you're not the landlord, you're the bank. Let's get right into it.
You know, if you've ever been a landlord, this slide probably hits home. The late night calls, the surprise repairs, all the tenant drama, it's the part of real estate investing that can just completely burn you out. But what if there was a way to get those real estate returns without all the headaches? And that right there is the core idea we're exploring. There's a strategy that gives you the security of a physical property and consistent cash flow, but it completely takes you out of the day-to-day grind of actually managing it. It's really just a shift in thinking, from owning the bricks and mortar to owning the paper that backs it.
So, what is mortgage note investing exactly? Well, it's actually pretty simple. Instead of buying the house, you buy the loan. That monthly mortgage payment the homeowner makes, it used to go to a big bank, but now it comes directly to you. In short, you literally become the bank, and you get to profit from real estate without ever holding the keys.
And this is where the strategy really starts to shine. I mean, think about it. You get passive income without ever having to manage a tenant. Your investment is secured by a real physical property, but you're not on the hook for its upkeep. The returns? They often blow traditional bonds out of the water, and it's a fantastic way to diversify your portfolio away from the ups and downs of the stock market.
Okay, so once you decide you want to become the bank, you've basically got two main paths you can go down, and each one has its own risk and its own reward profile. We call them performing and non-performing notes. So it's a pretty clear trade-off, right? A performing note is exactly what it sounds like. The borrower is paying on time every time. It gives you a steady, predictable, pretty low-risk cash flow. A non-performing note, on the other hand, is where the borrower has fallen behind. It's definitely higher risk, and it requires more hands-on management. We call that a workout, where you actively work with the borrower. But that's also where you find the potential for much, much higher returns.
For investors who really just want that steady, predictable income, performing notes are perfect. You're looking at really solid annual returns, usually somewhere in that 8 to 12% range. It's basically a reliable cash flow machine, and it's backed by a hard asset.
But here's where it gets really exciting. By taking on the challenge of a non-performing note and actually putting in the work to find a solution, the potential returns can just skyrocket. We're talking 15, 20, even 30% or more. This is your reward for being a problem solver, for turning a loan that isn't paying back into one that is.
Now, I know what you might be thinking. Those high returns sound great, but they also sound risky. And you know what? They can be, if you don't know what you're doing. But success in note investing isn't about getting lucky. It's about following a proven, systematic approach for every single deal you look at. And your protection against that risk really comes down to a disciplined, three-step due diligence process. First, you analyze the core assets. That's the borrower and the property itself. Second, you verify all the legal paperwork to make sure your claim is rock solid. And third, you plan your path to profit. You should know exactly how you're going to make money before you ever spend a dime. Theory is great and all, but let's see how this actually works out in the real world. This case study on a non-performing note out of Phoenix, Arizona is just a perfect example of the power of a well-executed strategy. Okay, just look at these numbers. The property is worth $185,000, and the loan balance is $120,000. But the investor didn't pay anything close to that. They bought this non-performing note for just $48,000. That's a 60% discount. This huge discount is the absolute key. It creates instant equity and gives you so many different ways to profit.
So, what happened next? Well, the investor didn't just foreclose. Instead, they actually worked with the homeowner. Over 4 months, they opened up communication, they took the time to understand the borrower's situation, and they negotiated a brand new, affordable payment plan. This is a true win-win. The investor created a new stream of cash flow, and the homeowner got to stay in their home.
And the result of that smart, strategic work? A 25% cash-on-cash return. Just amazing. By buying at that deep discount and creating a solution, the investor turned a defaulted loan into a high-performing asset, blowing the returns of a standard performing note out of the water.
So let's just recap real quick. We've seen the huge opportunity to invest in real estate without being a landlord. We've explored the two main paths, the stable performing notes and the high-growth non-performing notes. We've touched on the systematic playbook for doing your homework, and we've seen the incredible payoff in a real-world example. The principles are straightforward, and the potential is obviously significant.
It's a really powerful alternative to traditional real estate investing. So I guess the only question left is, are you ready to become the bank?